All right, everyone, welcome to this cross commodity webinar, the first one of 2025. For those of you who have may not joined in the past, we're going to walk through a number of critical commodities across the commodity spectrum, taking a look at expectations around price, supply and demand, and other things. We'll also be touching quickly upon what's been happening in equity markets since the Trump administration has taken power, and just bring all of this information together to try and provide a concise view around where we think things are heading, particularly across a number of critical commodity markets. My name is Reid Ianson. I am a macroeconomist here at Kepler. I will be moderating the discussion today. I am joined by my colleagues Florian and Alex, who are cross-commodity experts. They will be taking you through this presentation today. And again, I will be moderating the discussion. Keep questions in mind as we move through the presentation. We will have 10 to 15 minutes at the end of this presentation to take questions. And if we don't have a chance to get to your particular question, still send it in, and we will get back to you with an email response in the next day or two. With that being said, I'll hand it off to Alex, who will dig into kind of the what to expect around the Trump presidency, and also where equity markets have been and where they're heading moving forward.
Thanks a lot, Reid. Hi, everyone. So let's start with what we see for 2025, what we expect for this year. Of course, with the inauguration of Donald Trump presidency yesterday, it was a pivotal event. We saw that since his election, actually in 2024, November, 2 months ago, we saw significant changes across the market in terms of asset allocation. And we all know that Trump's statement and policy action will remain one of the key drivers of asset performance in 2025. Even if we look what happened over the last 10 days, we saw many changes either on the crypto side, but as well on the commodities. Commodities, for example, we had with the Biden administration help some geopolitical tension on the oil with Russia. We had an increase, a surge in oil prices. We know that there could be tension with Russia, Iran, China, but also changes in relationship with countries like Venezuela, Canada, and Mexico. Dollar as well, the strength has been a key topic since November, has been strong on the back that the US economy could be stronger. And actually, it is supported so far by the first earnings release we had from corporates for the Q4 so far. Of course, all this policy will also have an impact worldwide. We know that there are already some uncertainties in Europe from a political point of view, in France and Germany, for example, but also from an economical point of view, where the countries have already been a bit weaker. China still remain weak in terms of economy. Despite the fiscal stimulus plan, it's still lagging in terms of performance and still too much relying on investment. Bottom line, what we expect for 2025 on the stock exchange is more volatility compared to the last 2 years, and that means that we should favor tactical bet rather than directional strategy, particularly in the short term. Also because we are in an environment right now which is very data-driven, and the market sensitivity to economic surprise has reached an all-time high on bond so far. If we move on the next slide 2, we here touch on what happened since Trump election. So we had of course a huge increase on the indexes and dollar since the beginning of November. The dollar is up 5%, like the 60 days after his election in 2016. It was not a surprise for us yesterday actually that Trump refrained a bit on implementing aggressive tariff, because it supported in some extent the first day all the markets, and we know that Trump has frequently emphasized that the stock market is a key indicator for his administration success. So probably willing to have a good start for his mandate. At the right side of the chart, you can see the biggest winner, Bitcoin. Of course, it reached a new record of 42%. We also had even a Trump coin over the weekend with a very strong momentum. Equities in the US were still up, even if since mid-December we had a kind of slowdown. That has been supported by slightly better than expected inflation report last Wednesday, but as well as I mentioned earlier, a good start of the earnings season for Q4. Underperformance is still in China, where again the fiscal stimulus measure has proven to be too late and too small. And just to keep in mind, Chinese equity have faced 13 quarters in a row of earnings miss, and we'll probably have another one coming. So still weak in China. When we go on the commodities, what we are looking for today, and we move to the next slide, we saw mainly two key driver of performance over the last few weeks. The first one has been driven by weather, dry and cold. So that has been especially true for agri. So we had a surge on cocoa, what was already the case before, but continued since November the 5th, and as well very cold weather in the US, but also in Europe. I think we have one of the coldest months in January for more than 10 years, and it's even snowing today in Houston. So we had Henry up 50%. So weather pushed commodities higher over the last 2 months. And then, of course, what I was highlighting before, Trump election, and therefore all the policy behind, fears on tariffs, sanction potentially as well, and that pushed metals and oil prices for the last 2 months. Only coal, which is again linked to China, underperformed with a decrease of more than 19% over the last 2 months. If you move to the next slide, and to finish on the broad view of the market on the equity, last week was one of the best weeks we had for a while, again supported by strong banking earnings. It's worth mentioning that so far we had almost 20% of the S&P 500 that reported results, and it looks like that it's better than expected for a bulk of them. It's driven by financial so far. We'll have much more other sector and companies to report this week, but it looks like it's better than expected, and that support actually the dollar strength, showing that the economy is doing well. We're still speaking about a double-digit growth. So Q4 earnings are expected to be up 12.5% Q4 compared to Q4 of last year, while it was only expected to be up by 10 to 11% 2 weeks ago. So the momentum is still extremely good on corporate. We saw a kind of reallocation from one sector to the other. We had more allocation to industrial sector, as well as energy and material in the bulk, in the way of higher energy prices. What we mentioned earlier on bond sensitivity is true as well on equity, because the valuation start to be high, and any surprise could of course change the picture quite quickly. But so far so good. Let's see what will happen in the coming days. On the oil equity, just finally to touch a bit on the performance, which was good, but the earnings so far, we saw some warning even before actually the earnings. So that's true for Exxon and Chevron. So Exxon on a weaker margin, on refining margin due to decreasing gasoline demand, and Chevron was more around rising production costs and slower output growth. now that we show a little bit what we see from a broad market, let's move from one commodity to the other. So I will cover oil, and then later we'll have Florian covering natural gas, metals, and agri. So starting with oil, as you saw since the beginning of the year, the performance, the prices increased significantly. We can go to the next slide, Reed. Increased by almost 10%, but that doesn't fit with what we see from a fundamental point of view so far. In 2025, we see non-OPEC plus supply growth still to be higher than the global oil demand, so that will create a surplus. That's what you can see actually at the right side on the chart. The yellow line is 2025. And you can see that in the first 4 to 5 months, we have a surplus of 2 million barrels per day, which disappear, of course, during summer season, even entering a deficit, and then increasing a bit. So what could change the picture this year is other policy, more sanctions. So we already integrated Iranian oil export going down by 500,000 barrels per day. That's our base case, but it could be higher. It could be 1 million by mid-2025, depending actually on the negotiation between the US and China, as some of the buyers are private refiners and they will need to have agreement with the government. We already saw that there is some evidence of buildup of Iranian crude in floating storage. Some potential changes as well in Venezuela, but that's in a lesser extent because we only speak about 160 KBD. Is Chevron no longer hold a special license that enabled them to operate and export oil from there? And finally, the last point we already discussed a bit is Russian sanction, but for Kepler, we do not see a change in terms of production on Russian production. We expect the production to be stable. We even see that crude export could slightly increase because of lower refinery runs. And more importantly, we also see that China could be hit more than India in terms of flows, as the ESPO are the most impacted, and they are accounting for 8% of China's seaborne crude imports last year. If we move to slide 6 and we look a bit on the supply side country by country, we can see that we have a almost 1 million barrels per day growth, 0.8. It's the third year or even the fourth year in a row with a strong growth, much more than what we can see on the OPEC side. Since 2020, non-OPEC supply has grown by 2.3 million, while OPEC supply has declined by 1.5. So that's a big change in terms of market share, driven by the US, not on the shale oil side, but more on the offshore, Brazil, Canada, Norway, and China. That also means that there is no room, in our view, for OPEC plus to bring back oil in 2025. That's why we expect only their cuts to end or to start to end in 2026. Moving to the demand side, on the next slide, we have a growth slowing down year after year, 880 KBD in 2025, down from 1.4 last year, 3.4 the year before, on the back of the recovery on COVID by region, still mainly coming from Asia, for 60%, with 340 KBD from China. The penetration of EVs is expected to have a significant impact. It reduced the demand by 300 KBD. In the US, gasoline demand is expected to decrease slightly by 50 KBD. And in Europe, we have a declining diesel car fleet that will continue to weigh on demand, even if the easing of interest rates are expected to boost a little bit, but only in a small way. If we look by fuel, we have transport fuel, which are expected to decrease by 600 KBD to increase by 600 kbd, LPG by up by 0.3, but with fuel oil demand, which is expected to decrease. Very important on this slide, and you can see that on the chart at the right side. In 2025, it's the first year we will have a decrease in terms of refining capacity, down by 200 kbd. So that means that the product market could be supported a bit. It hasn't been the case for the last year. It will not be the case for the next 2 years. We have a closure of European and US refining capacity of more than 500,000 barrels per day. To conclude on oil, to move on the next slide, we can see that the momentum has been strong. The positioning has become stronger. The hedge funds and other money managers were net buyer of crude futures. If we look at the chart at the left side, the net long is at the highest for a year. Last time it was at that level, we had prices at $90 a barrel. It's also the case for CTA. The positioning has been extremely long, more than 80%. And as a result, that showed that the market could be changing very quickly should there be no real impact on flows. Our expectation on oil prices at the right side, going down back to 73, going up a little bit for the summer season, and then staying at 70 on Brent for the rest of the year. So pretty bearish on the oil prices so far, with the latest statement we have from the US. And now I will hand over to Florian, who will cover some of the other commodities Kepler is covering.
Thank you so much, Alex. So we're moving over to natural gas. In this segment, there have been two major events this year. First of all, Russian pipeline flows into Europe via Ukraine came to a complete halt. And secondly, the latest US sanctions are targeting two Russian LNG plants that were primarily serving the European market. Now, this begs the questions, is Europe's energy security at risk because of these two events? Overall, we don't think so. First of all, these two plants that the US sanctions are targeting are both very small. They accounted for around 0.6% of global supply last year. And secondly, and more importantly, this year and also the next year will be a strong increase in EU LNG import capacity. At the same time, global LNG supply growth is accelerating. Last year only saw 1 million tons of additional LNG supply, and this metric is likely to jump to 21 million tons of new LNG this year. This is mostly driven by the US and also Canada, and also higher utilization rates at existing plants in Asia. At the same time, EU 27 demand is likely to stay flat this year, meaning we remain at levels 20% below pre-war. Overall, Europe will manage to source enough gas to compensate for these reduced pipeline flows. Will this now also mean that the EU might ban the imports of Russian LNG? We don't think so. On the chart on the right, you can see that last year, the EU was the by far largest buyer of Russian LNG, 17 million tons. So that's a considerable amount, especially if you compare it to the LNG growth globally of 21 million tons. So we don't think that in the short term, the EU would impose any ban on Russian LNG. Moving on to the next slide, we provide you with our in-house price forecast. For TTF, we do expect an average of $12.6 per MMBTU. That's significantly higher than last year. However, the strength is more skewed to the first half of the year. The reason being that the winter ending stocks, which is a very important metric in the European gas market, are expected to come in well below previous year's levels. We think it will reach around 40% by late March, and that's 17 percentage point lower than last year. So this will provide a bullish base for European natural gas prices in the first half of this year. However, in the second half, once we see a lot of LNG supply coming online, we expect European prices to also tick down a little bit. Our main message in this slide is that, okay, we see higher European prices, meaning Europe will compete more strongly for LNG with Asia than it was the case last year. Last year, EU imports fell by more than 20 million tons. On the other hand, Asian imports rose by roughly the same amount. However, this year, higher price levels in Europe will divert more LNG to Europe. And also, an important factor is the freight rates for LNG. They are likely to stay very low because of around 160 new builds coming onto the water this year and last year, meaning this will facilitate the convergence between JKM and TTF. Moving to our Henry Hub forecast, it's a similar story. We expect a significantly higher price of $3.1 per MMBTU this year. And similar to Europe, the strength in the first half is driven by storage dynamics. Because of the extremely cold winter in the US, we expect a record monthly net gas consumption in January. And this paired with some production freeze-offs should eliminate the storage surplus that we've seen in recent years in the US and lift prices in general this year. The second main reason for higher US prices is obviously higher LNG exports. US exports are likely to jump by around 14 million tons this year, meaning the US accounts for around 2/3 of the global increase. US supply is likely to reach 108 BCF per day later that year, in line with the needed new gas to feed the LNG terminals. Moving to our next forecast for JKM, also slightly higher price than last year. However, the second half should see some weakness driven by the before mentioned higher utilization rates at regional LNG facilities. We see Canada LNG come online, which is targeting the Asian market. And also a very important factor is that Russia to China pipeline flows have been highly elevated in recent months. Second half might even see the return of price-sensitive buyers, but this, of course, hinges whether prices will fall below $12 per MMBTU. A last note on Arctic LNG 2, the Russian project. So our live data shows that so far not a single cargo has been delivered. 5 cargos have so far been discharged to floating storage units, and 3 cargos are still on board of the LNG carriers. And we don't expect a ramp up of exports anytime soon. Train 1, after all, remains shut since early October. Now we move to our next commodity section, which is metals. We start with copper. Copper had a very strong start to the year, and especially the US contract of COMEX strongly outperformed the LME. And it was likely because markets expected tariffs under Trump could reduce the copper availability in the US. Now, our main message here is we do expect that the COMEX LME spread right now is overdone. It has already narrowed a bit today, and we expect a further narrowing because the US import dependence on copper is significantly less than with other base metals. It's around 40%. And if you look at the composition of this 40%, around 2/3 of it come from Chile and Peru, where tariffs are less likely, and around 30% of this 40%, so effectively 12% of the total US needs, currently come from Canada and Mexico, meaning the volumes impacted by tariffs are likely relatively small. At the same time, Chinese tariffs and retaliatory tariffs will clearly lower US copper scrap sold to China, which should also provide a support to US prices. So main message here, COMEX versus LME copper spread is likely to narrow further. Moving to our next copper spread. If we compare Shanghai versus US prices, this spread has narrowed a lot in the recent 2 weeks. That's notable because usually Shanghai commands a significant premium across all base metals versus their US or European contract, simply because China is the global demand hub for base metals. So our outlook on the Shanghai COMEX spread is now, we expect it to remain relatively narrow. Less so because of strength in the US, but rather because of weakness in China. The first point is that Chinese exports of copper products are likely to remain very low. The country cut an export rebate, a rebate on the VAT paid in December. So this will reduce the incentive to export copper products. And at the same time, the US tariffs on Chinese goods will also limit the exports of Chinese copper. Now, this is an important point because Chinese copper production reached a record level last year. However, it was a strong export market that managed to absorb this surplus. Now, this year we see a similar trend. So last year we saw more than 1 million tons of copper smelting capacity additions in China. This year, this could rise to even 1.5 million tons of new capacity. So overall, the combination of lower Chinese export incentives and higher domestic copper production will likely speak for a relatively narrow Shanghai COMEX spread for the rest of the year. Now we move to our next slide, where we come back to the topic of the smelter additions that I mentioned. On the left-hand side on the chart, you can see in dark blue the new capacity in China. But you can also see that there's also significant capacity coming online in Indonesia, in Congo, and in India. Now, when we compare these smelting additions to the additions of mine supply coming online next year, you see this on the right-hand side. You see that the smelting margins, not only this year, but already for 2 years in a row. The big question now is, where will Chinese and Indian copper smelters get their copper concentrate from? Because out of these new smelters, in Congo and in Indonesia, they are integrated. They have part of these smelters will further reduce the availability of copper concentrate on the global market. So our main message here is this year we'll see an extremely tight market for copper concentrate. That's already reflected in very weak treatment charges for smelters. That's essentially the smelters' margins. And at the same time, it will provide some kind of bearish impetus to copper prices, to refined copper prices, simply because smelters will run, the total smelting capacity is very high, and there will be a significant hike in global copper production this year. Our next metal that we cover is aluminium. The copper aluminium spread at COMEX is a very closely followed metric. And also here, our main message is that we expect the copper aluminium ratio to weaken further this year. There's many factors driving that. First of all, the US has a much greater import dependence when it comes to aluminium than with copper. It's more than 80% for aluminum and around 40% for copper. Plus, the major supplier of aluminum, Canada, is a potential target of US tariffs. In terms of feedstocks, yes, we have copper mining capacity additions, and they outpace bauxite mining capacity additions. Plus, even more importantly, in Guinea, which accounts for around 70% of global exports of bauxite, we see a rise in political instability. Also, when it comes to Chinese metals output, we see a driver for a weakening in copper relative to aluminum, because aluminum output in China is nearing a regulatory ceiling, whereas copper production, as we showed in the previous slide, will likely increase even further this year. Also, in terms of demand patterns, copper typically boasts a much higher cyclicality than aluminum, and also the inventory dynamics currently speak in favor of a strong aluminum price. Aluminum stocks are low across all major exchanges, whereas copper stocks at LME and COMEX are still very high. Our last metal that we cover is gold. You can see on the chart that positioning in the gold contract has come off the highs from last October, and also the outright price has weakened a little bit. And this was mostly driven by a strong dollar after the Trump election, and also lower expectations for Fed rate cuts this year. At the same time, and in our view, the dominating factors are still bullish. We see a continuation of geopolitical tensions across a wide range of regions. Political uncertainty is clearly on the rise, especially with the newly elected US president. Also, inflation concerns are still there. We saw a strong US jobs report for December. We also view that Trump policies are inherently inflationary. He's likely to impose tariffs. He will likely limit immigration. He will likely be in favor of higher deficit spending. So overall, our outlook for gold remains bullish for the first half of this year. However, at the same time, the upside is limited, considering that the 10-year yields are already at very high levels. And our in-house economists believe that yields will even test 5% this year. So overall, main message, yes, there's upside to gold prices, but not a lot. We now move to our last section of commodities, agriculture, and we start with wheat. Here, the main message we want to convey is that wheat is likely to strengthen, especially versus corn. And this is mainly driven by a very precarious crop situation in Russia right now. The crop conditions are very bad, and which makes it very susceptible to winter kill, and this poses a very high risk until the end of February. And as a result, Russia only allowed exports of less than 11 million tons in the first half of this year, and this is a massive 18 million tons less than last year. At the same time, stocks in the Northern Hemisphere are at a 3-year low, and right now it's only relatively good supplies from Australia and Argentina that prevent wheat prices from rising more quickly. Another factor to watch out for is that wheat by now is so cheap that it will price into animal feed, and also this will contribute to a rebound in the next couple of months. Looking ahead, what should traders focus on regarding wheat? It's clearly the development of Russian weather and how this will impact the crop of Russia this year. Our next grain that we cover is corn. US exports last year have risen strongly by more than 50%. And we do expect the US to remain the dominant exporter until May this year. The US had a very strong crop, in fact, a record crop last year. It is still the cheapest option for East Asian buyers. And in general, there's just very little competition right now because Argentina, Ukraine, and Brazil all had a relatively weak harvest last year. Now, overall, we are bullish US corn. However, there are some bearish factors that could potentially arise. First of all, it would be a potential retaliation of Mexico towards US tariffs. So Mexico is the largest buyer of US corn. And if Mexico decided to limit this buying, this would, of course, have a significant impact on the US corn balance. Also, flows from the US to China are very likely to remain very low, not only because of the geopolitical reasons for such a shift, but also because Chinese imports of corn are in general very low right now. They had a very good crop domestically, and they are substituting feed demand with barley because this grain had a very good Australian crop. Now, in terms of outlook, the Brazilian conditions look very good for corn. Argentina, on the other hand, looks less positive. That affects both soybeans and corn. And this is also aside from the Mexico-US tariff standoff, the weather in Argentina is the thing to be watched in the next weeks because this will have an impact on soybean and corn exports this year. So main message here, we are bullish US corn, however, there's some downside risks. We move on to soybeans. With soybeans, the story is quite opposite. We expect significant pressure on US soybean prices this year. This is mainly because Brazil is expecting an all-time high soy year of enormous excess supply in Brazil will facilitate China's shift away from US volumes. However, it should be noted that because of the seasonality, a China-US trade war will only affect the 2025-26 crop. We did a regression on the soybean corn ratio versus planted acreage in the past. And as of now, if you look at the current soybean corn ratio, the price ratio, we will likely see US planted acreage for soybeans be flat year on year. And should there now be in Chinese buying of US soybeans, then the US would simply have way too much soybeans. In terms of outlook, as mentioned, we expect relative strength for US corn. We expect relative weakness for US beans. So overall, the soybean corn ratio is likely to weaken further this year. And this development could be even exacerbated by the upcoming harvest in Argentina. As mentioned, the outlook for the Argentinian harvest is weak because of not enough precipitation. And typically, drought conditions impact corn more strongly than soybeans, meaning the corn harvest of Argentina could be impaired even more strongly than the soybean one. Overall, main message here, soybean corn ratio is likely to weaken further this year. Our last commodity today is cocoa. We added it because cocoa was the best performing commodity last year. It surged by around 150%, mainly because West African supply collapsed by around a quarter. And other price drivers were there was an election in Ghana, and ahead of the election, the farm gate prices were hiked. Then the stock levels globally are at decade lows. However, we expect prices to settle at lower levels going forward. So prices have already come off this year, and we expect a level of around $9,000 for the rest of Q1, mainly because the supply outlook on West Africa has significantly improved compared to last year. At the same time, supply chains have stabilized, and also demand destruction could become a factor. However, this should not be overestimated, considering that the cost contribution of Coke of a typical supermarket chocolate bar is around 10%. So yes, it plays a role, but not a big one. Aside from lower prices this year, we also expect lower volatility in cocoa. You can see in the chart that open interest in the US futures contract collapsed in Q1 last year. And this triggered a phase of very high price volatility in the second half of the year. And you can also see that this open interest has slowly but steadily been increasing. It's not high yet, but it will definitely curb price volatility to some degree this year. Now, looking ahead, what are the risks? It clearly is supply concentration. Ivory Coast and Ghana account for around 60% of the global supply. And looking into next year already, the EU deforestation regulation will likely have a bearish impact on cocoa futures, because it will essentially create a two-tier market of beans that fulfill EU regulation and beans that don't. So main message here, cocoa likely to remain at around $9,000 per ton this year, and price volatility should trend lower. Thank you so much for your attendance, and we're now open to your questions.
Awesome, Florian. Appreciate that. Alex as well. Appreciate that presentation. We are going to step into about 10 minutes of questions here. And Alex, we'll go ahead and go to you first. You opened up the presentation talking about equity performance and the Trump administration. But we do have a question here specifically on the U.S. oil sector. Do you have an expectation for U.S. oil equities this year? And even with a lower expected oil price, do you see any attractive opportunities in the space?
So I think the answer depends as well on what will happen on other sector, because it's all the time linked in terms of asset allocation. Going from example, last year we had a big move still on Nasdaq, on AI, and that of course is not supporting like the kind of old industrial business. So it depends what will happen on the tech companies first. And now if we look specifically on the oil, we saw at least on the shale oil side a kind of decreasing cost. It hasn't been the case for the big oil, because we had a warning several days ago on Chevron on cost increase, but at least on shale oil, they could be improving margin at the stabilized oil prices. So here we could have some support, although especially as we know that for the next 4 years, there should be no new regulation or tax in the sector. So that could be supported. And I will highlight that probably it's an easy bet to say that the US oil equities will outperform the European peers in 2025. It's worth mentioning as well that we already had an increase in terms of oil equities for the last 2 weeks. It's already up 5%. So of course the upside is quite limited in the short term, also based on our oil price expectation.
Awesome. Thanks for that, Alex. For this second question, we're getting just a question about where oil prices are headed this year. And so we'll kind of stick to the theme of oil. I'm going to go to Hamayoun for this one. I did not introduce him at the outset of this presentation, but he is a critical oil analyst for us here at Kepler. Hamayoun, the question is, do you see Trump pushing for OPEC Plus production increases if Brent pushes above that $80 per barrel level for an extended period of time?
Hi guys. Yes, absolutely. I mean, this is what happened during his first mandate. It's likely to be doing the same this time around. And I think this time it's really going to be critical for him in order to reach some of his foreign policy targets, whether that's impacting, putting a lot more pressure on the likes of Iran, Venezuela, but even on the other side with Canada. All these measures will be impacting prices to the upside. And so pretty sure that for sure, given the very strong relationship that the Trump family has with the Saudi leadership and also with the Emirati leadership, the two countries where you have the most spare capacity in OPEC plus, pretty sure that he's going to be going forward to them and offering them, some kind of a deal behind the curtain if they go out and increase production. So, as Alex said, our view, the base case is that OPEC plus, because of the weak fundamentals in the oil market, is going to be further delaying its production hikes until 2026. But indeed, if prices are above a certain threshold, probably I would say above $90 per barrel for Brent, we would see OPEC plus go ahead with its production hikes. The only thing that, though, I think that is worth mentioning that is quite different compared to the first mandate from Trump is that the Saudi and Iranian relationship has changed, and Saudi Arabia would be a lot more cautious in increasing production at a time when Iran would be facing a lot more pressure and hence decreasing its own production and exports. So if production increases there are to come, they would need to be quite discreet, I would say, from the likes of Saudi Arabia and the UAE and being hidden in that official schedule from OPEC plus.
Got it. Thanks for that, Hamayoun. We have another question coming in. Flo, I want to hand this one to you, just around copper expectations. Why is your 2025 outlook on copper relatively bearish, despite all the energy transition applications that can come from copper usage?
Yes, yeah, our outlook is indeed relatively bearish for this year. This is mainly because of the Chinese demand weakness, not necessarily from the renewables in China. They continue to expand massively, but it's the construction sector in China, the extremely weak housing starts that are currently curbing Chinese copper demand. So at the same time, we have weak Chinese construction demand. The renewables expansion in China is massive, but not enough to completely offset that. And at the same time, we do have quite a strong growth in smelting capacity and mining additions this year. So with the prices will not collapse, of course, but we do not see a lot of upside from current levels.
Awesome. Thanks for that, Flo. And we are, just to kind of build on that topic, and I'll take this question as the macro guy in the chat here. Someone asking around, expectations for Chinese growth this year or through the rest of this year and where they might target growth. I think the general consensus for those of us at Kepler and for myself as a macroeconomist is that the problems with China right now is one of imbalances. They continue to be an economy that is an investment-led growth model. That model is starting to really come under serious pressure because the rate of outproduction is so outpacing the rate of domestic consumption that they really have to rely on exports to absorb all of this additional output. And of course, the Trump administration is going to likely, we did see some maybe a little bit of a softening in his position yesterday, but it's very likely we see the Trump administration ultimately take a very aggressive line on Chinese tariffs. And that could put pressure, as we have mentioned throughout this presentation, could put pressure on Chinese exports. And keep in mind that this is not just a US only policy initiative. You've got places like Canada, the EU, Mexico, Brazil, India. All of these countries are implementing import tariffs of their own on Chinese goods to protect their domestic industries, whether it is steel or car production or something else. And so I think the problem right now that China faces is they need to find a way to shift from this investment-led model that they've relied on for a long time towards a consumption-led model. And so I think that if we're thinking about a recovery in China that's more robust, we're going to need to see more fiscal stimulus flowing to households, not just monetary stimulus in the form of lower interest rates that flow through to higher investment activity. All right, it's looking like we're coming up on the hour. Flo, I'm going to hand one more to you, and then we'll call it there. Flo, just do you expect Arctic LNG2 to shut down permanently on the nat gas side?
I mean, obviously, it's a difficult call to make because it's highly political. Like as of now, it doesn't look good. So we see that there have been 8 cargoes loaded onto LNG carriers, but none of them were received by a potential buyer. So this shows that the US sanctions took their toll, and train 1, as of now, remains shut in. Still, we don't think that it's completely over with this project, especially considering that under Trump, an easing of sanctions towards Russia is a possibility. And if this were to take place, then we could also imagine that Arctic LNG2 might ramp up again. Obviously, a potential buyer would be China. They are still part of the, let's call it, price-sensitive LNG buying group, and with less US sanctions and sufficiently low prices on the LNG, it could be that China might receive some cargoes in future, but not in the near future.
Awesome. Thanks for that, Florian. With that, we'll go ahead and call this webinar. Thanks for everyone joining in. We intend to do these cross-commodity webinars on a regular basis. If you would like deeper amounts of coverage, again, we are hitting each of these topics in depth every single week within the Insights platform. If you don't have access, email sales@kepler.com and we can get you set up with a trial to check out what we do here. But with that being said, thanks again for joining. We'll see you next time.